We have with us Mr. Anand Shah, Deputy CEO and CIO of BNP Paribas Mutual Fund. He is joining us from our Mumbai studios. Thank you so much, Mr. Shah, for being with us on NDTV Profit. From here on, do you think the market consolidation is over and now the markets can head higher? Do you think there are many headwinds? Would you wait for those to clear, especially the global headwinds, before you think one can look at accumulating stocks?
Yeah, so to me personally, on the market levels, we will still have consolidation phase continuing. We believe earnings growth rate, while it will pick up from where it was in last 3 years, but at the index level, we'll still have subdued earnings growth rate. If you ask me, the more action is beyond index and beyond top 50 stocks, and that's where I don't see even now there's significant slowdown. There has been continuous excitement, and we believe if you are in the right sectors and right companies, I think there's still a lot of room for markets to continue to do well in 2 to 3 years to come by.
All right. So what are your expectations of earnings growth? You're not expecting it to be a blowout. Yes, better than the last 3 years. But what kind of consensus estimate growth are you earnings growth are you looking at?
So frankly, there's still confusion around what exactly the numbers would look like, given we don't know how much the demonetization impact is behind us, and there's still some to go. So on the large caps index, which is Nifty, we still believe the earnings growth rate will be between 10 to 15% in FY 18 over FY 17. But if you ask me, within Nifty also there are sectors which has been doing very well in last 3 years as well, in upwards of 15%. I think that's the key, that within a subdued earnings growth rate at the Nifty level, we had consistently for last 3 years also companies and sectors doing more than 15% earnings growth rate through last 3 years, and we believe they will continue to do well, and we will still have sub segments within the Nifty which will do in excess of 15-20% earnings growth rate, and that's where the stock picking and identifying those sectors will be more important from here on versus doing generally the index level earnings growth rate.
So give us some ideas where you think the earnings growth will be higher than 15%, higher than the Nifty earnings growth going ahead. Are they necessarily the ones that have done better in the last 3 years? Could there be any value stocks that have so far underperformed but now have the promise and the foundation to give more than 15% earnings from here on?
So our take is that even in coming years, we would continue to see, if I have to give you an example of that, within the banking segment, we have seen retail lending oriented banks have been doing well through the last 3 years, and we see no reason why in the coming next 3 years they will continue to do better than the corporate banks. Having said that, we still also see some opportunities within corporate banks also coming up, but again, it's not generally that all the corporate banks will start doing well, but we will see 1 or 2 opportunities within that segment also which will start doing well as their NPA cycle bottoms out. But coming back to your question, that would there be a new sectors emerging, that's more outside index, that's more within the mid caps and the small cap space, where we are seeing interesting opportunities coming by on the back of government spending on roads, on railways, on infrastructure. Also opportunities around the farm sector. If the agenda for the government is to double farm incomes in next 5 years, we will see opportunities there. Housing for all is something which is again a big initiative by government, and we'll see opportunities around that. So on the earnings variance, we are going to see much more in mid caps and small caps than in large caps. Large caps, we are seeing more of the same even going forward.
All right. So, Mr. Shah, can you talk to us about how one can pick from the mid-cap names where you think there could be significant outperformance when it comes to earnings growth as well as the price performance?
So let me put it this way, that there are opportunities, more opportunities to do stock picking in mid-cap. So I was just discussing before they started that from here on the markets, you will have to be more bottom-up. You'll have to be more picky and choosy. The easy money is sort of behind us, and to that extent, going forward, stock picking will matter, and that's where we see more opportunities in mid caps and small cap. And that's where I would believe that we'll have mid caps and small cap outperformance, though it will be volatile compared to large caps, but it will continue in times to come.
All right. So how can one pick? Should one just go and look at mutual funds that invest in mid caps? There is a bottoms up stock picking, but for those people looking to invest, how should they do it?
So within mutual funds, I think the best route of investing into any mutual fund is obviously the diversified equity, which will have enough and more mid caps. But if you want to move and go, if you're a seasoned investor and you want to pick mid caps also, given the valuations and the run up which we already seen, I think the SIP, STP route is the ideal way to invest into mid caps and small cap funds at this point of time. Generally, if you're a new mutual fund investor, you can easily start with a diversified equity, which will have its 20 to 30% in mid cap anyways. So that would be my advice, that given we have almost had a good rally in last YTD 3 months, SIP, STP is a better route, and gradually entering into the mutual funds and the markets would be a better option than to do a lump sum investment at this point of time.
Say if somebody wants to do an SIP for 3 years or next 5 years, these 2-3 months move, the sort of valuations that are currently there would really not matter?
Yeah, exactly. But it so happens that when you do lump sum investment, and if you have an immediate correction, there is almost sort of a agony across the cycle, be it investor and distributor. And to that extent, I have always believed, and I have always maintained, that if you are a long-term investor, actually the 3 months move doesn't matter. So even if the market were to move up further in next 3 months, it doesn't matter. And to that extent, SIP, STP is the best way to invest. It reduces a lot of volatility in your investments and reduces a lot of agony for the investor also to that extent. Given that generally the perception for the investor community as a whole has been that investing in equity is very risky.
Right. Let's talk about some sectors and some stocks now. Financials have done pretty well here in India, especially the private sector banks, which have been managed very well, or NBFCs also, which have great asset quality. Do you see them continuing to lead the index, or do you see them continue to outperform?
Yeah, so it's a partly a structural story as well, that the retail penetration of in India, particularly on the lending side, has been very little, and there's enough and more room to continue to grow that piece significantly. On top of it, there's always an opportunity to gain market shares within the banking industry pie, and to that extent, it's a double that one, the sector anyways would grow faster than the GDP, but there will be opportunities, stock picking opportunities, where there will be one-off banks and NBFCs which will continue to gain market share. And to that extent, we have seen quite a few opportunity businesses which we own in our portfolio as well has been growing consistently for 20% plus for many years, and we don't see any reason why they cannot continue to grow in excess of the GDP growth rate for years to come.
Right. Can you just tell us what has changed with NBFCs as well? So private banks, of course, have been growing. It has been led by HDFC. Yes Bank has done very well. What has changed in NBFC in the last 2-3 years that all funds want to own it?
So again, it's basically the bottom of the pyramid. So while at the top end of the retail market, the urban households is all well, covered by banks. But what has happened is obviously there's a new opportunity coming by at the bottom of the pyramid, lending to the unorganized sector, lending to the non-salaried people. That is something which again has done very well for years. It's just that the investors have warmed up to it recently. But for us in our portfolios, we've been owning quite a few those companies in our portfolio for last 5 years, and they've been doing excellently well both on the growth side as well as on the asset quality. So we have a superior growth rate with very little asset stress at this point of time, barring last 2 quarters where the demonetization has upset that NPA cycle for a brief period.
Right. Retail sector, as you said, has been growing, and that's because of penetration as well. But do you think that the corporate loan book or the corporate demand for loan has to also go up? That has to be the trigger for retail to continue the way it is?
Yeah, so that's true that, at the end of the day, if you don't have a capex cycle going, when will be the jobs created, and if jobs don't get created, how the retail. So that I agree that there has to be a balance to all of this, and there's no denying that at some point of time the private sector capex also has to catch up, and to that extent the corporate lending also has to pick up. But as we see, that's still a couple of years away, and to that extent we are in no hurry to actually latch on to that opportunity. We will obviously are on top of it, and as I said just before, that there are a couple of opportunities emerging within the corporate banking side also, and we'll see as and when those opportunities come by, we'll add to our portfolios.
Right. Can you just tell us that recently, in the last 15 days or so, we've got a sense again, looking at the RBI circular, looking at the management commentary of IndusInd Bank, Yes Bank, that there is some tightening which has happened from RBI regarding recognition of NPAs. Do you think once this pain is behind, maybe a year and a half, only after that the capex cycle can pick up?
To me personally, they are not that. They're not strictly correlated. It's not that the banks are not ready to lend to the corporate sector. It's an issue with utilizations. So today you have large capacities in steel, in cement, in power. So power, the PLFs are low. In steel and cement, the utilizations are low. So frankly, there's no need of the private sector capex straightway in our traditional sectors. Yes, there is some FDI and some private sector capex picking up in renewables and others, but as such, it is not that there's a dearth of money available to do lending. There's enough, and our belief is there's enough and more money and enough and more ability for banks to lend to anybody who has a viable project and wants to put up a capacity. But the fact of the matter is today, with the growth rates which we are looking at, which are not very, very exciting, and the low utilization on largely large sectors, we don't see actually private sector capex picking up irrespective of availability of loan and interest rates.
Right. Apart from financials like NBFC and the traditional banking names, do you think insurance as a sector, or maybe mutual fund business which you operate in, or any other financial inclusion is also an interesting sector to play this upswing?
So yeah, the entire NBFC space, as we say, has opportunities, and within that a bigger and sustainable opportunities in the retail space. So yes, beyond banks and NBFCs, there are financial services opportunities which are always there. Though the opportunities to do stock picking and invest into them are just emerging now. So there were not many opportunities in the past, apart from brokerages. But within the insurance space, yes, we will see a couple of opportunities coming by where we can invest into.
Right. If I look at your top holdings, so of course it's the financial space which we have discussed in quite detail. I'm talking about the large cap funds. And then you have, some other interesting names. So you have a telecom exposure to Bharti Airtel as well. You have Vedanta as well. These are not structural names or names that have grown. So tactically on metals pack, do you expect further gains?
So metals, we've been sort of constructive in last 6 to 9 months, given there was a recovery in China. And of course, after the change in presidency in US, we are expecting some kickstarting of the capex cycle in US as well, given they wanted to invest into infrastructure. I think on back of that, we did increase our exposures to the metals, particularly non-ferrous ones, and I think they have done well for us so far, and we believe there's still a little bit of leg left there for metal prices to continue to do well. But we believe, it's not something, as you rightly said, it's not something structural. And at some point of time, we will have to see how the Chinese capex cycle as well as the US capex cycle plays out. It's more an international play rather than domestic, and it's a continuous journey to keep on looking at how metals will play.
What is your call on the steel sector? We are seeing increasing protectionism across the world for the steel space. Do you think that's a problem for Indian companies as well?
I think that's been a sort of a savior so far. If you ask me personally, this sector was in distress 6 months back. It's a minimum import price which has sort of supported the domestic prices. Sector has been under pain because of a severe overcapacity globally, particularly in China. And to that extent, there will always be a cyclical opportunities to play as far as ferrous metals is concerned. But structurally, it is some time away that one can turn positive, given there's a huge supply excesses globally compared to what the demand for steel sector would be in years to come.
Right. In terms of metals pack, do you believe that returns from here on may be moderated? So only, as you're saying, you've been constructed on the metal space for a while now. So only if you are constructive and you're holding at lower levels, one should hold on. Otherwise, fresh entry, could lead to risk as well.
Yeah, definitely. Because we've been also getting early signs of there's some softening of raw material prices, particularly iron ore, as we see, and to that extent, it's not that comfortable at this point of time as it used to be 6 months back. So, as I said, we will continuously look at this sector, be watchful, and at this point of time, we don't see any signals or triggers to believe that there's still room for a significant increase in metal prices at this point of time.
Right. Let's talk about oil and gas, particularly. Do you think, at least in India, names like Reliance, some of the other oil marketing companies, the oil sector in India is still an overweight, even if oil prices were to remain where they are?
To me personally, look this way. Between oil and gas, frankly, the much sustainable and a superior story is in the gas space. Very clearly, we believe over the next 5 years, gas will outperform oil, given its globally, the demand supply makes sure that the gas prices would be cheaper than they were in the historic times, and to that extent it will become more viable. It's much cleaner fuel. Plus, if you see the investments happening across the board, gas turns out to be a winner in the entire oil and gas competition, if you ask me. Having said that, yes, today the bulk of the energy demand of India has been oil, and to that extent you can't ignore that. But if you want to play growth over the next 5 years, gas clearly is a winner among the entire energy space.
Right. So despite the recent run-up in the gas sector, it's still an overweight?
Yeah, it's still an overweight for us, and we will continue to look for opportunities in that space, be it in distribution, be it in transmission, or in other spaces.
Right. Just a word on value emerging in any sectors. You think IT is coming to a space where there is value, or you would wait for the numbers to pick up for some of these large cap names?
We've been underweight on IT, and as you rightly said, that there is some value emerging. But if you ask me personally, it's too early to take a call, particularly because of the recent rupee appreciation. So in the past, whenever we had couple of times the rupee appreciation, the volume growth used to be much higher. This is the first time that the industry is facing twin issues of a weaker volume growth rate as well as a rupee appreciation, and we don't know what would be the impact of that on the sector and on the EBIT margins as such. And to that extent, we've been still waiting to see how it pans out over the next 2 to 3 quarters, both in terms of demand as well as on the currency. I'm not even talking of what would be the H1B related issues, if any, because there's still some time away. But for the next 2 quarters, what matters is the volume growth, recovery in BFSI sector, as well as the currency. And this is something which we'll watch out for next 2 quarters before we'll reduce our underweight, despite of the entire penchant to buy value and they're becoming value stocks as such.
Right. And what's your view on pharma? Their valuations are expensive or not factoring in full risk?
I think pharma as a sector has become a lot tricky in the last 1.5 years. Frankly, valuations, while we can keep on talking, only matters when we actually have a predictability of earnings. What has happened in the last 1.5 years has been a huge loss in terms of predictability of earnings. If historically pharma sector used to be getting a premium valuations, one reason was that they had a predictable and a very superior earnings growth rate. Now both predictability as well as a superior growth rate has been at a risk for 2 reasons. One, obviously the much talked about US FDA, and that's well known to the market at this point of time, which leads to the future approvals not coming through and a future growth at risk. But a less known talked about worry has also been a pricing pressure in US. So there's been a significant pricing pressure. Our analysis tells us there's a severe pricing pressure on the US generics market, given there's a consolidation in the distribution channels in US. So combination of both actually makes it a little more trickier at this point of time to gauge earnings growth rate for the sector. And in light of that, frankly, the valuations is very difficult to make a comment on, given we don't have predictability of earnings.
Right. Anand, thank you so much for taking out time for us. Always good to get a perspective.
Thank you.